Emergency webinar QE 5.0 has officially begun. Last week, breaking, Treasury Secretary Janet Yellen's holding an unannounced emergency meeting today that will include top financial regulators. The meeting will be closed to the public. Net result, the Fed's balance sheet has grown $400 billion in the last 2 weeks to bail out the banking system globally. Meanwhile, money is flooding out of banks into money market funds, going to $5.1 trillion. But what happens next? The bond market's predicting the Fed will pause in May and then start dropping interest rates rapidly. That's going to flush the $5 trillion out of the money market funds into the stock market. Buy these 5 stocks for instant profits now. Central banks are really screwed and they're printing money rapidly. Year-to-date return for our high-risk portfolios sitting at 20.57%. Our total return from 2021 to 2023 is 270%. That means we're outperforming the S&P 500's 8.5% return by 3,066%. Our high-risk portfolio in March is up 4.48%. Let's look at the high-risk portfolio allocation right now. We just did a trade alert today. Currently, every unit of investment costs $3,804. All members follow the same ratio, so we get the same results over time. On the defensive side, we topped up slightly with UVXY at 42 shares, or just around 5% of the portfolio. And again, up top, if you're in the membership area, you can punch in how much money you want to invest. It does the arithmetic and automatically tells you how many shares to buy so you get the right ratios. We're long US Treasuries TMF, that's the TLT times 3 with 98 shares coming in at around 21% of the portfolio. And again, that's our defensive side. If we're about to have a mega crash, credit crunch, and recession, those are the products that are going to make us money. That's not my base case, though, and why we have a lot more capital in the offense. We're long coin with 17 shares at 29% of the portfolio. We're long FNGU with 14 shares at 33% of the portfolio. And we're long NRGU with 1 share at 10% of the portfolio. Now, coin is our play into digital currencies. It's the rebellion against the system where governments spend trillions of dollars they don't have, and it's just getting worse and worse every single year for all major countries. FNGU are the big tech giants who are about to have massive breakthroughs with AI. The AI is getting out of control, and if you want exposure to the top holders of AI technology, buy FNGU, which gives you these big tech giants leverage times 3. Now, NRGU is the big oil and gas companies leverage times 3. If you've noticed what Warren Buffett's doing lately, he's loading up on NRGU. About a third, just a bit over a third of his portfolio is either in banks or oil and gas companies. Now, we like the oil and gas for a better return. So if we look at this, essentially, we're about 60% long tech between Coinbase and FNGU. We've got a small oil hedge, leverage times 3 with NRGU, and I do think we'll want to increase that slightly soon. We've got the safety play in treasuries, betting that interest rates are about to fall because the Fed's going to cut interest rates and that we're about to have a global slowdown with TMF. And if all things break loose and we start to get a big rapid crash, we have a small hedge in UVXY. If we get fearful that things are getting far worse with the banking system and the Treasury is not going to be able to respond to it, we could add to UVXY. So more on that to come. Here's a look at our track record. Last year, we were up as much as 55%. We gave a lot of that back in the winter with some surprises to the energy markets, but we're picking back those gains quickly this month and sitting on a 5% return for March. Now, if you want to be more conservative and play a very similar strategy, but just a lot more safely, we have the Safe Growth portfolio. It's up 5% in March in 2023, and it's got a twice the size hedge in treasuries, sitting at 44% with TMF. Rather than being long FNGU, we're playing Asia. Asia is a great setup when interest rates are very high and the dollar is highly valued against other currencies. So we have EDC, that's EEM times 3. Rather than the NASDAQ, I like the safe play with GBTC, that's BTC, at 22 shares. And then we have a bit bigger inflation hedge, a little bit closer to Buffett's, with NRGO coming in at 17%. Its return this year is at 4% and had a similar return as the high risk portfolio the last year. This portfolio has been going on for a year longer and did a 25% return in 2019. 2020, we played it safe, made 4%. 2021, 25%. Last year, we gave back 25%, but this year we're already back up 4%. And if you want to learn more, call Dean now at 505-322-7515. Okay, so here's what's happened to the futures curve predicting what the federal funds rate will do ever since the banking crisis began developing. And it started with a few banks in the US, but it's now spreading globally. And we're seeing this in who's borrowing money from the Fed's overnight emergency systems. But you can see the market's now priced in no more rate hikes and rapid rate cuts. And this is going to be to get money to stop pouring out of banks, which are going after that 5% money market yield, which again is going to get cut as the federal funds rate goes down. Here's a look at the extraordinary liquidity and lending facilities. And what's critical here is the breakdown. A lot of this money is heading out of the country. So we saw Credit Suisse collapse, Deutsche Bank's CDS spreads are going out of control. There's just a global problem for banks that have liquidity problems. Essentially, they all bought bonds. Bonds went underwater as central banks jacked up interest rates. And now if too many people want their money out at once, the banks can't get out without taking a loss on the bond. So it's forcing the central banks to open up massive lines of credit to central banks and banks so that they remain liquid and don't dump their bonds, which would of course collapse government's ability to spend money. So there's a lot of pressure to open up liquidity and drop interest rates right now. And again, there's that Fed's balance sheet. 6 months of quantitative tightening reversed in 2 weeks. And they're likely just getting started. Now, here's the key. For central banks to drop interest rates, they have to have falling inflation. All leading indicators point to the next 6 months dramatically showing a reduction in inflation. So it's going to be the perfect time for the Fed to pause and start dropping interest rates as inflation falls rapidly. But we got to be careful because this trend will likely last for about 6 to 12 months. And then China's reopening is going to finally start impacting markets, and we're going to have another wave of inflation. So we've built a small hedge into oil today, and we'll likely double or triple that in the coming several quarters, anticipating that China's reopening will finally start putting pressure on the oil markets. And again, that's one of the key barometers of inflation. This is another look at predicting inflation. We've got the M2 supply, which is now going back up, but you can see it's giving us a headwind of about 12 to 16 months of falling inflation based on the money supply being dramatically reduced. PPI, CPI are both following that lower. So this is going to be the perfect time for the Fed to pivot. And this is going to make interest rates fall and be very bullish for risk assets. Another way to predict inflation is to look at the euro-dollar curve. And it's also predicting not just a flattening of inflation, but a crash in inflation. And again, if we think bond yields are about to fall, things like digital currencies and tech stocks are going to fly. But as we're going to get a steepening yield curve from the federal funds rate getting dragged down much lower, we're likely to also see a bull market in commodities. If we look at China and Germany as a leading indicator, we can see China's inflation from the PPI standpoint has been back to normal for quite some time. And now we're seeing Germany's PPI following suit. If we look at job postings, same picture. We still have elevated job posting in the services sector, but everything else has crashed. We're heading towards lots of layoffs if the Fed doesn't get careful here and pivot. And a reminder, we're in a time period that's unlike any other in history. This is the first time where the US government debt to GDP, the earnings price ratio, and the consumer price index are all at extreme levels. So they just don't have the tools they had in the past to fight inflation without collapsing the debt bubble. So unless the Biden administration wants to balance the budget, they're not going to be able to get away with this current policy of having high interest rates at the federal funds rate. Now, do we think we're hitting a recession imminently? Jeffrey Gundlach says it could be months away. I'm just not seeing it. We're seeing housing sales rebound, and we've got $5 trillion sitting in money markets. That's going to get squished out when the Fed pulls those interest rates down. U.S. consumer spending is still at very high levels, hitting a new record. The balance of trade slowing down, which is good for, of course, having less inflation. Retail sales is flat, but still elevated. It's not crashing. Consumer credit, despite this relative panic, is still growing. Bank credit's still growing. And now we got China's PMI is going back above 50. So we're not seeing a recession in the near future, as Chinese imports and exports are also once again off the charts as they're aggressively printing money. Let's break this trade alert down step by step. So per unit with the high risk portfolio, you'd be buying 17 shares of coin. Here's a look at the chart. Past month, it's flat. It was up a bit till the Wells notice was served. We do believe they'll get around that with probably a fine. But it's down 65% in the past year. Again, we're entering a new cycle where everything that worked in the last year and a half will be the opposite this year. So we want to be along these duration assets. One of the key assets in coin is ETH. And you can see it's up 10% in the last month, even with all this negative news and governments going after this asset class. In fact, in the last 5 years, this is one of the best performing assets in history. And again, the main reason we like digital currencies is we believe governments can't help but grow debt to sustain their activities. And here's just a look at the history of growth debt since 1970. It rarely goes down. And when it does, it goes back up even faster. We just went through one of those rare periods where the money supply slowed down. But as we need to grow the debt, they're going to have to push the liquidity back into the markets. And here's the U.S. federal budget deficit projection, which is dramatically less than reality. We're looking at more like a $1.6 trillion deficit in 2023, not $1 trillion. By the time we're in 2032, we'll probably be running $3 to $4 trillion deficits. So we're going to have to live in a world with higher inflation to keep all these government entitlements intact. Now, this is digital currency cycle chart that perfectly lines up with bond interest rates. Bond interest rates are way too high out of cycle and are likely going to crash until about 2025. So we've got the perfect setup to send BTC to 200,000 or greater. Okay, next play. The main thing that would screw up our whole plans would be too much inflation coming back, forcing the central banks to make a hard decision to keep monetary policy tight. And what would likely cause that would be oil going back above 100. If oil is going anywhere towards that level, NRGU is going to make a ton of money. So that's your hedge against inflation. Here's a look at the chart. In the last month, it is essentially flat. In the last year to date, it's down 9%. And in the last 5 years, it's down 65%. But it's had run-ups in the $600 to $800 range twice in the last year and a half. Here's a look at oil. And you can see it's starting to bottom out and get strong here. If the U.S. tries to refill its strategic petroleum reserve and China gets full-blown reopen, which is slowly happening, their travel's still way slower than you'd anticipate. This is going to go right back up towards the $80 to $100 range and drive NRGU higher. So we love this as a key hedge right now. We're out of BOIL. This one didn't make money for us this time. We had warm weather, huge oversupply, and we got out of this because we don't see an immediate catalyst to make it do really well compared to oil. So we're out of BOIL. We made a lot of money on it twice last year. The third time was a failure, and we did add to it once. I think this winter, if the war in Europe is still going on, it might have a way to make us a good money again, but probably not till this winter. So for now, we're into NRGU for the inflation hedge. Just a mega collapse in this asset. Crash Insurance, buy 42 shares of UVXY. We're finally seeing UVXY behave properly, giving you about 10 times the return that's the SPY goes down, which is what we like and what it wasn't doing for the last year and a half. So I've added a little bit to this. If I get very fearful of a big recessionary credit crunch crash, I'd like to get us up towards 10 to 20% on this. For now, we're in the 4 to 5% range and just hanging on with a small position. But this product, again, has had a rough year. But again, here's why we like it. When there's a massive stock market crash, such as March 2020, when the world went in lockdown, UVXY went up 1,000% when the S&P 500 went down 25 in a month. So that means if you had 10% of your portfolio, your entire portfolio doubled while your stock position only lost 25%. And again, that takes a very rare crash to pull off that type of return. This is just comparing the VIX from 2008 to today. The only thing I would say that could create a replication of what we're seeing in 2008 would either be nuclear war in Europe, which nobody's pricing in, obviously, to markets, or inflation just staying elevated and not coming down and even resurging higher. That would certainly be detrimental to markets right now. But my data shows inflation should fall hard for about 6 to 18 months. And again, that's going to be potentially shortened by how much money central banks have to print right now to bail out the banks. Bonds, buy 98 shares of TMF, the deflation hedge. We're betting interest rates are going to fall because inflation's falling, plus the Fed's going to drop the federal funds rate, which will bring down the whole curve. TMF's up 8% in the past month, down 50% in the last year, and it's up 3% on the TLT. Now, again, TMF is just a leveraged product on the TLT, down 21% in the last year. Let's look at some other bond markets that fuel the stock market. We got the LQD investment grade bond looking healthy, up 2% in the last month after being down 10% in the past year. The junk bond market, which we've seen a lot less issuance because of these ultra high interest rates, still hanging in there, not crashing or collapsing, down 0.7 in the last month and only down 10% in the past year. Now let's look at some of the individual government bonds. The 3-month is flat and actually down 2% in the last month. So this is predicting that the federal funds rate is done. We're basically even with the federal fund rate on the 3-month. But this is one that went skyrocketing up in the past year to 800%. And this was, of course, forced up by the Fed hiking interest rates up at the fastest pace in history. The 2-year is already way below the federal funds rate by 75 basis points and has collapsed 15% in the last month. Again, this one was rocketed up forcefully by the federal funds rate. The 10-year, again, has fallen even more than the rest of the curve, down 10% in lower yields over the last month after rising 48% in the past year. If we look at some of the more leading indicators, such as lumber futures, this is down 11% in the last month and 60% in the past year, indicating that inflation is coming down. Copper, flat in the last month, even with China reopening, and down 12% in the past year. Baltic Dry Index, cost to ship commodities between continents, is down 40% in the past year. And you can see it's in line with historical levels, so it's back to normal. Wheat futures, flat, even with a lot of the supply getting destroyed by the war, and down 28% in the last year. We're not currently in the US dollar, but let's take a look at the DXY index, falling from 105 to 102. We believe this will probably bottom out in the 90 to 80 range by 2025, and that's where we're going to want to take massive, massive profits off of treasuries, digital currencies, and tech stocks. Here's a look at it in the past year. You can see it rocketed as high as 112.5 and has come back down. This is the yen versus the dollar, starting to stabilize after being dramatically devalued last year. It's starting to strengthen a bit. And again, this is all because inflation is coming back down. China's currency has been making some interesting moves, but all in all, flat in the past month and has only devalued against the dollar in total by 8% in the past year. Now we can see it was worse by October, but now the Chinese yuan is starting to strengthen against the dollar. Stocks, 14 shares of the tech giants, FNGU. Never been a more appealing reason to get long these stocks since the conception of ChatGPT, which was gobbled up by Microsoft. All these big tech giants have AI coming alive right now. People like Elon Musk and a bunch of these tech giants and AI experts are putting out a waiver to try to stop development now beyond this ChatGPT 4, which is going to revolutionize the world. So very exciting time. Hopefully it doesn't end humanity, but if you want to get rich from that, sorry, we lost my monitor there. FNG is your way to play that. Excuse me, guys, we got a little technical. There it is. FNG is up 19% in the past month after crashing 60% in the past year. Again, I believe this will top out around 2025 for massive gains. The S&P 500, despite all the doom and gloom, is flat over the last month and only down 11% in the past year. The NASDAQ's up 5% in the past month and now only down 13.8% in the past year. We're coming into a market cycle where emerging markets will likely outperform US markets. And so this chart shows you that often these cycles last shorter, but you get some pretty extreme returns. So we're long EEM in the safe growth portfolio with the product EDC. So it's EEM times 3, down 15% in the past year and up 1.75% in the past month. Europe, we're looking for contagion from the war. No signs of it. Their stock market's doing just fine and their economy is doing much better than expected. Down less than all the other indexes in the past year. Now, when we get back into the inflation play, probably in about 6 to 12 months aggressively, we'll also consider some products like uranium with ticker URA, down 6% in the last month and down 25% in the past year. We'll look at rare earth metals, which gives us exposure to things like lithium for car batteries and phone batteries, which again is all controlled by China, down 5% in the last month and 33% in the last year. If you want more information, call Dean now at 505-322-7515. That is the end of the presentation. So now I'll go into Q&A, and after throwing up our disclaimers, I'm going to go back to the trade alert and then take questions. We have quite a big crowd live. George says, is UVXY scheduled to do a reverse stock split soon? I'm not sure, but I'll check on it. And if it does, it won't change what you do. You'll already have the right exposure. So whether they reverse or split, it doesn't mean you change anything. It just means I'll go either cut the shares in half or double them in the calculator. The dollar value will be exactly the same. So you won't have to do anything on your end. A lot of people say, should I hold on to BOIL indefinitely? No, follow the trading plan at all times with no exceptions, and don't hang on to losers just because you feel bad you lost money on it. And I know there's a lot of you out there who probably went more aggressive on BOIL than the trading plan, and now you just want to hang on to it. Absolutely don't do that. Switch to NRGU. I think that one has an immediate profit potential. Yeah, so to make the trade alert today, I had to double the ratio. Otherwise, NRGU was going to be like 40% of the high risk of the safe growth. So here's what I did just mechanically to do the trade alert. The first thing I did is I went into the calculator and I doubled all the shares. So the ratio didn't change, but what did happen is the unit cost doubled. Then I was able to go sell off some of the assets and buy NRGU without it being 40% of the total portfolio, which I think is just too aggressive too early, because NRGU is expensive compared to the other tickers. So that's what I did. And that's why when we teach you to rebalance, we don't tell you sell one of these, two of these, and buy 4 of those. It's much easier just to log into the calculator, look at the total value of your account, punch it in. If any tickers are gone, that means you need to completely sell that. If you have too much, sell those down and then buy the new ones. Gary says, what's the chances they don't raise the debt ceiling? 0. We got a bunch of cowards in the Republican Party. It's not going to happen. 0 chance. Let's see. Taji Tong says is NRG is slightly better than FNG. They're the polar opposites. So Warren Buffett, just to be clear, his portfolio has a massive Apple position. That would be similar to Coin and FNGU. And then he has a huge position in Chevron, Occidental, Bank of America, Wells Fargo. And that's very similar to NRGU. So those two go hand in hand. In our high risk portfolio, we're way less hedged against rising interest rates compared to Buffett. He's about 30 to 40% would be in the oil / banks / Coca-Cola, things like that are inflationary. Our safe growth product is a little bit closer to his with 17% in NRGU. Now, again, I think we're still at least a month away, or excuse me, another quarter away before I will get more aggressive and add to NRGU. So that's what I'm thinking in terms of when we'll. So I think we've got about 3 to 6 months. We're going to see probably things like Coinbase, FNGU just scream higher without hurting our oil position. And then I think we're going to see the oil get too expensive, and then it's going to start to put pressure back on yields, and that's when I think NRGU could outperform. But it's good to have the mix. Yeah, so I think I think we're about to have a very weird period. So basically, I think the Fed's going to start to cut rates, and it's going to steepen the yield curve, and it's going to make the whole yield curve fall lower. So I think Treasury yields are about to fall in general for the next 3 to 6 months. And I think you're going to see the offense go up together, which is rare. You don't usually have oil and tech go up at the same time. And then what I think is going to happen is the inflation is going to get too hot and they're going to have to start tightening again. And then I think the whole offensive side is going to be basically at risk. So if we start seeing oil get back towards 90 to 100, we should probably get worried that the Fed's going to have to tighten again. I'm not an expert at the mining stocks. I like the GBTC a lot better than the gold products. Ed's saying, will that set us up for a big recession? Yeah, I think probably the recession is going to be 12 to 18 months out and probably happen in 2025. So, but what we want to see is the yield curve steepening aggressively, and that's usually when you're entering into and then unemployment. So the problem is we have really strong labor markets, we have really strong retail, and we've got $5 trillion of cash to dump out of money markets. So I'm just not worried about a recession anytime soon. I'm much more worried about the economy reheating too hot, and then they have to tighten again. That's what I'm worried about, because they essentially globally added so much money to the global money supply. It's still there, and they only got away with reducing a tiny bit of it before they're going to stop. So this is why there's all this hot economy globally, and and again, this went from 4 trillion up to 9 trillion. So they barely got they got less than $1 trillion out of their balance sheet before the whole system collapsed, and add back $400 billion. So basically they're stuck. They're going to have to let inflation run hot. So we want I like this mix a lot. I basically just don't see any reason to do anything outside of this exact setup. So give me 3 to 6 months. We'll likely take some profits off of Coinbase, FNGU, and add it to NRGU is what I'm thinking will be the next play. Ed saying, have we seen AI cause layoffs yet? No, there's no layoffs. I mean, the job market is very strong. Unemployment's very low. The labor force participation rate is still lower than pre-lockdown, but Boil maybe in winter if the war's, I don't know. We'll look at boil. The problem with boil is we had a warm winter that was way warmer than normal. We had Europe, especially Germany, turn off their industrial sector dramatically. And then they put all sorts of restrictions on using heat to combat the war. And now there's just a massive oversupply of natural gas all over the world. So until that starts getting depleted, and so perhaps the end of the war would actually help get the use of boil back up. But yeah, NRG looks like a better play for now. China's turning back on, and as you saw, their imports exports are out of control. It just takes a while for that to play out. So here's the credit impulse. Usually China leads the global inflation cycle by about 2 years. So this is actually predicting we get the inflationary pressure from China towards early 2024. Yeah, the dynamics for boil are not back. So Europe got caught off guard with no alternative to boil as the war went on, began, but now they've adapted to it. So I just don't see a good reason to be in boil. And I was waiting to make the switch until I was a little more confident that basically I wanted to wait till I thought the Fed was going to absolutely pause before I put us into a bigger energy play. And I'm extremely confident the Fed's pausing in May. So I think the commodity markets, the bond markets, and the tech stocks are all going to enjoy the Fed pausing. David's saying, where would you park your cash? Big banks. Yeah, go to Wells Fargo or Bank of America. If you're over 250, if you're below 250, you have nothing to worry about. And most likely they're going to increase that to 500,000 to help with the bank problem. Yeah, Tom, Rebel is to replace Coin and GBTC. So if you want to get a super aggressive position in Coinbase, you should invest in our private equity firm, Rebel Dividends. We're basically giving you a triple leveraged version of Coin. Yeah. Anything below I would, don't have more than 250 in a savings account. Split it between multiple banks because you're still FDIC insured for that. Now, if you, and I do think they're going to double that in the coming week or two to 500,000. But the problem is that that doesn't fix the problem. It's like a small Band-Aid. The problem is this. If you move to a money market fund, which takes it out of the bank's deposit, it basically lowers their ability to loan and their liquidity and their ability to buy treasuries. All that is ruined as everybody is saying, oh, I can go get 5% at a money market fund. So the only solution to fix the banking crisis is to drop interest rates a lot. And then what's going to happen when that occurs is money is going to get out of money markets and go back to other homes, which could be stocks, digital currencies, commodities, or just back to a normal bank account. So that's what they have to do. But they're not going to do it unless inflation is falling. Luckily, we're highly confident. We've got about a 6 to 12 month run of inflation falling aggressively here by the China cycle, by the M2 cycle, by looking at the euro dollar, and then looking at China and Germany's producer price index. So we're, and then if we look at some other, if we really break down the CPI, there's a lot of reasons to think it's going to fall for about 6 to 12 months. And then we're probably going to have some new issues as inflation is going to get hot again. And that'll be lovely as we lead into the next election cycle. So And the other thing that's going to be happening soon is the Treasury needs to raise a lot of money. They're down to about $168 billion, and they need to get that back up towards 500 to 800 billion. So the second the debt ceiling comes online, a lot of Treasury is going to hit the market, and that's going to probably be a big boost for your NRGU position, because the market's going to see a ton of money coming in, which will probably stabilize bond yields, if not make them rise a little bit. And it's going to make the market predict a lot more money flooding into the economy, which would increase oil usage. All right, so the M2, they've been decreasing the money supply for about 2 years, and it leads everything by about 16 months. So they've basically dragged the red line 16 months ahead of the CPI and PPI to show that it's correlated. And so this is predicting we're going to basically crash the CPI for about another year. But the catch is this chart's not updated. Now the M2 supply is going right back up. So we got about a year. I think we've got about around a year of falling inflation, and then inflation is going to come back. And then we're going to probably have to tighten monetary policy. David Green says, I hear small banks will eventually go away and lieu of very large banks. That's been the trend for about 80 years. The big banks are gobbling up the small ones. So yeah, that's definitely been the trend. The banks have generally underperformed the market, so I'm not a big fan of buying the banks. And they've got a big threat, which is ETH, is basically replacing their whole financial system, but much more efficiently without it being unfair to certain parties. So that's kind of our play on technology and the banking system in one play is Coin, or ETH. So yeah, we waited about 3 months for this trailer. We've been talking about it forever. Basically, I just really wanted to be highly confident the Fed was going to pause before we added NRGU. And that moment in time is now. I'm extremely confident May will have a pause on rate hikes. Thoughts on the CBDC? It's coming. They want to control money and be able to control the economy with it. So absolutely. There's this whole new legislature passing that can spy on you on your social media coming through too. So big government is trying to get bigger and bigger. And your rebellion out of that is Coinbase or ETHE or GBTC. Yeah, we're actually, so Aaron's saying, are we looking at a product that would be like a savings account? Yeah, we're actually planning a third product. So we have Rebel Dividends, which is basically a super leveraged bet that digital currency is going to go up in value with the weekly dividend. We have the DeFi Income Corp, which is doing yield farming to create income. So less growth, but more income. And then the very third product, which will probably launch next winter, most likely at the earliest, is going to be a super high interest rate savings account product where we trade basically stable coins against stable currencies, either the dollar or the euro or things of that nature. So we would try to outperform money market funds by trading stable coins in this new economy that's quickly developing. So yeah, that'll be the final product we see coming on the private equity side. So yeah, we're still playing GBTC. So I like GBTC for the safe growth product because it's trading at a discount to the underlying asset. So I like to get cheap stuff in the safe growth strategy. Emerging markets is super cheap PE ratios right now. Treasuries are oversold more so than ever in history. And oil and gas is pretty drawn down, energy on about 50%. So everything in this portfolio is just cheap. So I'm bargain hunting. If I'm trying to make the most money, I don't think ETHE has a chance to outperform Coinbase. And so for high risk, I'd rather have coin over ETHE. And then what I'd rather have over coin is Revel dividends, because we're giving you a triple leverage product. So again, once we get a bull market, Rebel dividends will be extremely fun to hold a position in, which I think we're on the verge, because again, this is finally happening. We're literally 2 weeks into the next growth of the Fed's balance sheet. Great questions today, guys. Thank you so much. So schedule coming up next week, we have the Rebel dividends dividend on Monday and webinar on Tuesday, and we will have the next portfolio builder webinar this Wednesday. There's no important economic data next week, but the week after we get the new CPI print on the 12th of April, which I believe is either Tuesday or Wednesday. So we're positioned for that to come in dropping. So unless it's not dropping, we have no reason to change the portfolio whatsoever. If it's dropping, our prediction that the Fed can pause will play out. So if we see the CPI come in hot April 12th, we'll have to rethink the portfolio slightly. But I find that very unlikely. Yeah, things are pumping for one reason and one reason only. It's because of this. Fed's balance sheet's going back up. Now, a lot of people are going to say this is not QE. And the reason why they say that is because this money is being lent against treasuries to banks at an interest rate. So it's depleting the bank's profitability and doesn't really solve the problem. But think one step further. What solves the problem is get the money out of the money markets fund, which means they have to drop interest rates. And the bond futures are already predicting this is going to happen. So that's why markets are super excited, not necessarily because this is happening, but because this has to happen. The interest rates have to be cut. And that's going to bring down the whole bond interest rate curve. So if interest rates go lower, it reprices the value of financial assets higher. Stocks are competing against the future returns of other products, such as US Treasuries. So it's been a while. The inflation was hotter and stickier for longer than I thought. And that's why we don't have better returns right now. But the data has been falling inflation for quite some time now. If you go to your email and click it, David, it'll replay it, the Rebel webinar. As far as an archive, we do for sure on the channel. I'll have to figure out how to find those and send you links. But yesterday's you can listen to right now if you just go to your email and click that link. Yes, sir. Okay, very good, guys. Well, we'll see you back twice next week if you're in Rebel Dividends, and once if you're in Portfolio Builder. Thank you so much for joining us live. And again, in 2 weeks, we get the next CPI print, which will be probably one of the most watched CPI prints in history, because it will be the monumental time where the Fed can finally pause the fastest rate hikes in history and then get ready to start cutting possibly. Again, we would need more falling inflation and probably more problems in the banking system for them to actually cut. I'd actually be happier if they just pause for now. But if the banking crisis continues, their only solution will be to cut those interest rates.